All right, let's talk about both the markets and the economy, which have been helped along by large amounts of government stimulus. However, all those cash infusions are also causing some concerns about growing inflation fears. Is it possible that we could keep seeing this incredibly strong economic data right alongside maybe not so great performance for stocks? Joining us right now to talk about that is Koch. She's co-head of the fundamental equity business at Goldman Sachs Asset Management. And what do you think the answer is? Could we see a great economy and a lousy return for the stock market?
Becky, I think the good news for everybody is that we're actually probably going to see both, that we're going to continue to see a strong economy. And we also are set up actually for some great equity market returns here. We're fundamental investors, so we look at the world through our companies. And maybe I'll just give you a quick couple of data points around earnings, because I think that can help us understand that. We've obviously had about 70% of the S&P reporting, a little bit more than that. 90% of them beat expectations. Three quick takeaways from that, and one investment implication. The first takeaway is cyclical recovery underway. Management teams feeling great. Second, Mike just talked about this earlier, but definitely seen a lot of signs of inflation, copper, construction, even Crocs, the issue of the pandemic, being able to put through price increases. And then against that backdrop, this big rotation is happening. So we've had 13 years effectively of growth leading value by 300%. And since September, values led growth by 20%. And we think that could persist, which leads to the implication. It used to work for investors to just be in the top 5 big tech companies and play the growth and the deflation trade. We think now investors are going to have to be much more balanced in their portfolio, compete in some cyclicality, and also look at small caps.
That's interesting. So you think this rotation that we've seen recently out of the big names in the NASDAQ, that continues?
We do. And we're not suggesting a wholesale selling of those names. They're obviously great platforms. I'm happy to talk about them in more detail, but people are going to really need to look beyond them. And I think it is a good time to have balance in the portfolio. So a good thing to find in this market is cyclically geared names, but they're tied to great secular outcomes. So for example, travel. That is something that we like secularly because we know millennial consumers have a preference for experience over things, and that can give cyclical exposure in your portfolio. We saw Caesars, for example, reporting on Tuesday that weekend bookings are fully booked in Vegas, and there's other data points along those lines. Another area that one might want to look at would be some of the mining space that's actually connected to the secular story of a transition to a net zero climate. So there are ways to pick up cyclical exposure while still aligning with the strong secular outlooks of those themes.
Katie, you mentioned the travel stocks, and it seems to me that many of those stocks have really come roaring back. They're anticipating a full recovery. You think there's even more room to run, though?
We do, because what you're experiencing right now is this pent-up demand, because obviously we all want to go out and have more fun, and we are along this trade of having more fun. But actually, again, the secular story here is this very, very enduring desire of millennial consumers for experience over things. And so the runway is not just about the next quarter or two, it's really a 10-year runway. And we think a lot more people are going to be pulled into that preference of experience over things. So it's not just travel, it's also would include things like concerts, for example. And then just the one point I wanted to come back to cyclical. I know that we talk a lot about U.S. markets, but another place people may want to look to pick up some cyclical exposure would be in Europe. Europe is 1 or 2 quarters behind where the U.S. is. So if you feel like you've been left behind on some of these value names, look to Europe, because that market is going to open up, and you're going to see a lot of the trends that happened in the U.S. play out in the European market. And also, of course, it's at a 16 times price to earnings multiple versus the U.S. at 22. And the market itself is much more geared cyclically. And there you could look for some secular winners, certainly in the transition to the green economy, many of which are listed in Europe. And you could get that cyclical exposure with a secular runway.
Shepard Smith here. Thanks for watching CNBC on YouTube.